London is faced with a new reality. Its investment attractiveness is fading. In 2022, foreign investment in the London property market, usually very attractive to businessmen from all over the world, has collapsed to £12 billion. A year earlier, they were $16 billion, and at their peak in 2015, they exceeded $30 billion. This was caused by financial instability in Britain due to inflation and the budget crisis. In addition, Britain shot itself in the foot, starting a wholesale fight against the oligarchs from Russia and ex-Soviet Union. After all, Russians were one of the main investors in Britain. The total value of their seized real estate exceeds £2 billion. Britain has also managed to ruin relations with another key investor, Qatar, which was heavily criticized during the World Cup. Qatar, in response, is reviewing its investment plans in Britain. The country owns 2 million square meters of real estate worth £35 billion, and London is going to have a hard time without new expected investments from Qatar. China also refuses to invest in Britain lately. The influx of new money from China to London has collapsed 10 times in 5 years. Chinese businessmen are well aware that in the current geopolitical escalation around China, their property can also be expropriated at any moment, as it happened already with the Russian one. The British property market has started to crumble. Experts say that sales could drop by 30% next year. The real estate prices have also rushed down and could collapse by 8% in 2023. Due to the sharp rise in rates caused by attempts to fight inflation, mortgages are becoming unaffordable for many Britons. The winners of all this situation are the Americans, who are buying up British real estate on the cheap. But their money cannot replace all the investments from Russia, the Middle East, and China. Britain is plunging into a long recession until 2024, and it will be extremely difficult to get out of it without foreign investments. Britain at the moment is experiencing the deepest recession among the G7 countries. Experts say in 2023, the British economy may shrink by 1%, while the EU and US economic performance will be slightly better. Although a recession this year threatens most Western countries, London found itself in a perfect storm situation. On the one hand, the rise in inflation and the energy crisis. On the other hand, political instability and a wave of strikes. Business does not know what to prepare for. After all, a coherent economic policy is no longer pursued against the backdrop of the Prime Minister's leapfrog. Last year, soaring electricity prices in Britain closed a record number of small businesses. For example, the number of retail stores that went bankrupt alone exceeded 17,000, an average of 47 stores a day. Because of dropping demand and consumer spending, restaurants and pubs experience shrinking revenue and often have to close. To make matters worse, railroad strikes, which have cost the service industry £1.5 billion in lost revenue, have their customers simply staying at home. Moreover, the strikes do not even seem to be ending. On the contrary, another 5-day strike on the railways is now beginning, which will lead to the shutdown of 14 railway operators and will affect the departure of 40,000 trains. 2023 could turn out to be an even tougher year for the British economy than the previous one. According to forecasts, the real income of the British people will fall by 3.8%, and the share of those below the poverty line will rise sharply. Already, 37% of Britons are unsure they can handle even a £20 increase in their costs in a month, with further increases in utility rates planned this year, coupled with higher taxes. The Bank of England recognizes that serious improvements in the economic situation cannot be expected until 2025. But what Britain will be like by this time, no one can predict. One thing is clear: the way out of the structural crisis into which London has driven itself will be long and difficult. Thank you for watching this video. Please let us know your opinion in the comment and subscribe to the new videos.